self-storage has been in such high demand, since the last recession, because so many people were out of work and they were moving back home and they were consolidating, moving in with each other. And then right after that, on the heels of that, came a big boom time in which, what we do in this country is when things are good, we forget about the last recession, we buy a bunch of stuff and then we don't have room for it. So we put it in storage. And so that's created a huge demand for storage. And so it's done very, very well during these the past several years. And so people have seen that, they've seen self-storage facilities going up all around them, in some cases across the street from each other, even more so than Starbucks. And so it is, many people tend to think then, oh, well, the market must be saturated, there must be too many. And you could argue that has happened. Certainly, that has happened in some markets, but there's a number of factors in place in the marketplace that really keep or prevent that from happening.
Scott, thank you again for joining us for our Thought Leader Spotlight series. I'm your host, Matt Camp, head of partnerships for DealMachine. And on these, we really try to shine a spotlight on industry experts like yourself to really hear your inspiring stories and educate our audience on the lessons that you've learned over the years and really where you see the market evolving. So today, really excited to bring on Scott Meyers. I know you're a top expert in the self-storage investing niche, been involved in that since 2005. You own and operate over 1,400 doors and 2.4 million square feet nationwide. So you have quite the extensive history there. You're an educator. You've got a top podcast. You write for Forbes. You've got events, courses, all kinds of stuff at selfstorageinvesting.com. So make sure to check that out too. But welcome on, Scott.
Hey, thanks, Matt. Good to see you again. Thanks for having me.
Yeah, excited to have you on and to really start. I'd love to dig a little bit deeper about your story and how you even got involved in this world. So can you maybe talk about your journey on the real estate investing side and how you came to the self-storage niche specifically?
Sure. So I think like most people started out in real estate with a single family rental house. I began learning about it by buying the Carleton Sheets home study program. Some of the folks on this call may recognize that name, and we're going back a little ways. And then in 1993, bought my first single family house. And so we rehabbed it. We refinanced it and rented it out. So doing the Burr method before it was called the Burr method. And then we took those proceeds and rolled it into two more, just like it. We were able to find also at that time some assumable VA mortgages with no approval. You could just assume these mortgages as long as you were comfortable with the interest rate and the terms of the loan itself and had enough money to put down on it versus the purchase price, you could step into these projects. So we began seeking out other projects like that in the bread and butter neighborhoods, the working class neighborhoods here in Indianapolis. And we got up to about, I'd say we had about 40, 50 houses or so, and then decided that we wanted to, take advantage of economies of scale and get into multifamily. So started buying multifamily apartment complexes around central Indiana. And we found ourselves with about 420 apartment units. And we had about 78, 79 houses, I think at the time. And didn't really have the freedom in terms of time and the cash flow that Mr. Carleton Sheets had talked about in his program. It all sounded great in the book and on video, but the reality is we had a lot of, and it's tough, I think, for the folks out there that are at that place or have gone beyond that place or leading up to it. I mean, it's tough until you get to the place. Even though we had property management companies, there's still a lot, even at that level, that an owner has to do and get their hands in and be involved in, and decisions to be made. And I was working full time, up to the point where we started getting into apartments, and that was really taxing on our time, and the weekends were spent on the business. And even after that, there's just things that come up in that side of the business until you get beyond that that tipping point and have an entire team that you can afford to have on payroll to handle even the more minute details. And so began looking around the landscape and thought, love real estate for all the reasons everybody loves real estate. And that is because you can borrow money to buy it. It depreciates. You can force the appreciation, and it does appreciate on its own. And then you put renters in it in rental real estate, and they pay down your basis for you. I mean, there's no other investment that has all of the benefits that real estate does at the current time. So if it just weren't for the tenants and toilets and trash, everybody'd be doing it, right? So we looked around the landscape and thought, well, if I want to get away from tenants and toilets and trash, I got self-storage and I got parking lots. And there's really not a lot of depreciation. There's not a lot of ways to force appreciation and value in a parking lot. but there certainly is in self-storage. And the more I dug into the asset class, even more so than I had anticipated, and even more than in houses and apartments. So as I began to learn about the business, there weren't too many people. There really wasn't anybody teaching it at the time. I paid some consultants, spent a lot of time with some mentors to learn about the business before I got into my own, and then got into business with a partner so that we could share some of that risk and the learning curve ourselves. And we bought into I guess for our first facility, a sizable facility. It was 4 acres. It was $2 million, just shy of $2 million, and 400 units. And so we stepped in, we took everything that we had learned and got a lot of consulting along the ways, and put some technology in to reduce the amount of hours that somebody worked in the office by way of a kiosk. We raised the rents and filled the thing up using all the best marketing and business practices that we knew about the industry at the time. And then we bought the building next door that had another 3 acres on it. And then we built more buildings. So we got into our second project, included a development, and we built more units on that one and filled it up. And then my partner bought me out. I saw the light in self-storage and sold everything else off. And then since 2005, we've just been full bore 100% into self-storage. And one slight correction on your bio, Matt, we're up to 14,000 doors nationwide, not 1,400 doors, but that it makes a difference. The square footage gives it away.
Yeah.
And we've gotten really good along the way at syndicating and raising private capital, private equity partners that we bring along with us in our projects. And we convert old industrial buildings and grocery stores and any other types of commercial buildings into self-storage as a higher and better use as these uses have changed. We buy ground and develop from the ground up. And then, of course, continue to buy existing self-storage facilities where we can add value. And then along the way, we created an education company, and that really never set out to be an educator or a guru, if you will. And we were running the local real estate investor association here in Indianapolis. And just by nature of getting into the business and buying a number of facilities, there's a lot of people that were wanting to learn about it. So we started holding workshops. And to make a long story short, got a lot of national attention from some of the agencies that were booking speakers and authors. And so they put us out on the circuit and started teaching people about it. And lo and behold, it just kind of turned into a business on its own. And so now we've trained and taught more self-storage professionals than anybody else on the planet at this point. And we partner with them as well. We raise capital alongside of them, and we do some wholesaling. We buy from a number of the folks that we consult with and work with, and they buy from us. And we built this incredible community of self-storage investors out there where when I got into the business, there was none. So we created this industry of folks, the community of self-storage investors that are working together and trading deals with one another.
Yeah, I love it. And appreciate you fixing the typo there.
No worries.
But I love to hear your story of how you organically, found this niche, and how, did your research to find, where can you get all the pros and none of the cons from that perspective. But how do you see kind of your strategy evolving, with the market? I know it's been crazy the last, 6 months especially, but would love to hear your thoughts. Since you are a leading educator in that space and you have your finger on the pulse of the industry, where you think things are headed, how you're pivoting your strategy, if at all, currently.
Well, you put a lot of hope and faith in me, Matt. My crystal ball is in the shop right now being repaired. It is. Here's what we've seen and what we know. I've been at this real estate game again since '93. Going through 3 recessions, and we've been through the tech boom. We've been through '08. We're heading through the pandemic and into our next recession. And here's what we know about self-storage, and that is historically it does extremely well, much better than the other asset classes during a recession. Because when we head into a recession, a depression, when the economy faces any kind of a hiccup, like we did with the pandemic last year as well, even though that was more than a hiccup, self-storage benefits. People downsize, businesses downsize, and they put their stuff into storage. During the pandemic, specifically speaking of last year, we had kind of the triple whammy, and that is, first of all, states, cities counties were locked down, depending upon where you lived, and people were sent home. Well, the schools were sent home. Everybody in college put their dorm room stuff into storage, and that created a huge demand for storage right out of the gate, where they didn't know they were going back, where they were just storing for short term or leaving it at college. They had to move everything out. So we had a big bump in occupancy. Then the rest of the schools shut down. And so mom, dad, both were forced to create a schoolroom or a place to do school at home. which meant that the extra stuff in the dining room or a spare bedroom or wherever was now turned into a school. And then everybody got sent home from work. So now they had to find more space at home to create a workspace for one wage earner, perhaps two, and doing school somewhere else. And so we had folks that were trying to find room where they didn't have it in their houses. And that just meant moving furniture and things out and into storage. And then, of course, with the lockdown, there are so many, tens of thousands of businesses that their doors shut down overnight. And so their excess inventory, furniture and anything left of the business as they gave up the business or gave up their lease or moved out of the office was put into storage. And so again, we really had a triple whammy that went into our favor. So we don't celebrate pandemics, Matt. We certainly don't celebrate recessions, but we know silently we cheer a little bit because we know that this means, it's time for us to step up and be able to serve and help folks. And we know that we need to get our A game on because, this is our time to shine. It's our Super Bowl, if you will. And so storage already benefited from the fact that we've been touchless since before it was cool to be touchless. I mean, our facilities have kiosks where anybody can walk up to a unit. And some of our facilities, 24 hours a day, walk up and go to a kiosk and they can rent a unit from us 24/7 or pay their rent without ever coming into contact with a person. We can also manage our facilities by way of our smartphones. We have apps on the phones that are linked to our mobile website where they can rent a unit by way of the phone, make the payment, get their code to enter the facility. And then ultimately, they either bring a lock to our facilities that have the older style or the new style that have key fobs on them that they pick up in a box at the facility, and they can move in. All done by way of technology and their smartphone without ever coming into contact with a person. So our industry, at least those of us that were already tech enabled to have the ability to rent units without ever coming into contact with a person, well, we didn't skip a beat. So we have this huge demand. We were ready for the rentals. And so occupancy has gone up dramatically. Rental rates have gone up incredibly. I mean, they continue to go up all across the country because we still can't keep up with the demand for self-storage. And we haven't even headed, deep into the next recession. I mean, some folks think that we're in it now. Some folks would say that we're heading into it or on the cusp of it, depending on how you look at it. Again, my crystal ball says that, we're seeing the markers. One of those is RV sales are down. Anytime that RV sales are down 2 quarters in a row, some of the economists will say, well, we're in it or we're heading into a recession. But you look at the bond yields and what's happening in the stock market, interest rates, and all the markers are there that we should be heading into a recession here very soon. And again, not that we celebrate that or are looking forward to it, but we are anxiously preparing for that time. And all the facilities that we've been building over the past several years, and especially this past year, we know we're poised to be able to lease up pretty quickly. So all that to say that I'm very bullish on self-storage and what is going to happen in this next market cycle. As for the rest of real estate in general and or the economy, boy, it's anybody's guess because the news that comes out every day with regards to what our federal government and those in power right now, the decisions that they're making, you just shake your head and you think, gosh, could they really? I mean, you can't make this stuff up. And every time we turn around, it's just like, oh my gosh, they did it again. They made something else up that topped the last one. So I don't know what's going to happen in this next recession and what that means for real estate. All we know is that we are staying opportunistic. And we are poised and ready with a whole bunch of our private equity partners that we've gained over the years and our lenders to go take advantage of the market, whatever that means as it hits.
Yeah, I mean, do you think so? People who are, there's probably a good number that are listening to this right now that aren't in the self-storage space. They might be considering it as a unique and creative, alternative option for investing. For those new people, do you ever see any concerns about a market becoming too competitive or too saturated? Like, how do you kind of coach people through that potential concern?
Yeah. Well, that's funny you bring that up, Matt, because I shouldn't say funny because that's the number one concern that people have. It's self-storage has been in such high demand, since the last recession because so many people were out of work and they were moving back home and they were consolidating, moving in with each other. And then right after that, on the heels of that, came a big boom time in which, what we do in this country is when things are good, we forget about the last recession, we buy a bunch of stuff and then we don't have room for it. So we put it in storage. And so that's created a huge demand for storage. And so it's done very, very well. during the past several years. And so people have seen that, they've seen self-storage facilities going up all around them, in some cases across the street from each other, even more so than Starbucks. And so it is, many people tend to think then, oh, well, the market must be saturated. There must be too many. And you could argue that has happened. Certainly, that has happened in some markets, but there's a number of factors in place in the marketplace that really keep or prevent that from happening. And one of those is that, well, first of all, if you're going to go deploy a bunch of capital with a bank and your private equity partners, you should have done your homework. And if not, then the bank is certainly going to do their homework as well. So when we look at a market, when we look at a piece of ground that we're going to develop a self-storage facility, obviously the first thing that we look at is we draw a 1, a 3, and a 5-mile ring or radius around that site. We survey our competitors, how many square feet are out there, how many units, and then we look at the population. And one of the beauties of self-storage is that it's a fairly predictable business model. And we have some benchmarks in the industry that we can point to. So even initially, we can see that if we're at roughly 6.5 to 7.5 square feet of self-storage per person, say in a 3-mile radius, that's generally considered equilibrium. It means market meets demand. The facilities that are competing against each other, they're at 85, 90% plus occupancy, and rates are high. They burn off all their concessions and their deals. When we get up to 95% occupancy, that means that most likely there's less. There's maybe 4 square foot of self-storage per capita if they're all full and raising rates on a regular basis, or they have a waiting list. Conversely, if there's 10, 11, 12 square foot per capita, they may be at 75, 80% occupancy, not raising rates, and they're somewhat undercutting each other and offering, move-in specials, and it's a little more of a competitive market. But most developers aren't going to go into a market that is, has 10 or 11 square foot of self-storage per capita and think, well, I'm going to do this better than anybody else, and we're going to take all this risk, sign on the dotted line and guarantee the loans, and the bank's actually going to give us the loan after they get the appraisal or the feasibility study that shows that the market is maybe overbuilt or oversupplied. And then you're going to try to convince some equity partners to come in and invest with you, and it's going to take longer to lease up, which means it's going to be tougher to produce the returns for them. I mean, there's the markers in the market itself that kind of prevent it from becoming saturated or oversupplied, so that it is non-competitive. It doesn't mean that some folks can come along and it'd be the wild, wild west, and you got some lenders that are willing to throw money at anything, and developers that are a little over optimistic, and some equity partners that they've talked into coming in with them without looking at their homework or their due diligence. That can happen. It's more of a rare occurrence than it isn't. So, long-winded answer to your question, Matt, I'd say that folks that are looking to get into it right now, we're seeing changes in the tax law. We're seeing the highest valuations that we've ever seen on storage facilities, and so these sellers are selling out, and they don't want to take a tax hit or see what's coming down the pike. They paid these off. They paid them down. These are the baby boomers that have been in these facilities for a number of years, and they're ready to exit. And so we've got a pipeline full of properties right now that we are taking down and evaluating. And so the market is strong for self-storage right now. At the end of the day, you just need to make sure that you're doing your due diligence and dotting your I's and crossing your T's.
Yeah. And I know I appreciate the detailed answer there too, even given the full context, especially since you said, hey, this is the number one reason that people may be hesitant. So that's great. So I know you mentioned doing your homework for people on this call. Can you talk through maybe just the high level playbook of saying, hey, yeah, I want to get into self-storage, like where do I start? What's kind of the steps there? Obviously there's not a one cookie cutter approach, but I'd love to hear your recommendations on what that playbook could look like from a high level.
Sure. So a number of factors, and the first starts with just aligning yourself with good folks. You don't need to build out a team to begin with, but you do have a number of folks that you need to have really quickly on speed dial on your Rolodex. Get yourself a good broker to be aligned with, to begin looking into the market. And then that person could also be a resource as you're looking on your own. If you're doing your own marketing and sending out mailers or postcards, or even just knocking on doors and talking to the facility owners or the managers at the facility, and hopefully getting to the owners. When you find a project, an opportunity that you're looking at writing an offer on or taking down, then you need to make sure that you're really good at the numbers, the underwriting, or you need to find somebody that's really good at underwriting, because that's where this is where we make money, by knowing exactly what we're looking for and the experience that we have and how to underwrite a facility properly, and then cover the hidden value in it. but it's also the place where newbies make the biggest mistakes. They may take a profit and loss statement or a management summary report from the software from the owner or a broker. And I'm not saying that owners of self-storage facilities or brokers are looking to, pull the wool over anybody's eyes, but if you don't know what you don't know and you don't know what the averages are, how do you know that those numbers are real? And can those numbers be affected under your ownership? You can either overpay for something or you can overlook something because you didn't recognize what an opportunity was because some of their expenses were overstated and they hadn't raised rates in 15 years because they just wanted to stay full. This is, real estate is finance. Finance is real estate. And so you need to understand the financing side of this and how to properly underwrite and analyze the facilities. So get really good at doing that, or find somebody on your team who can come alongside of your underwriting and make sure it's good. And then after that, there's nothing wrong with going out and blasting out your marketing pieces and talk to as many people as possible. If you find too many deals, well, then get plugged into a wholesale network. And clearly that's one of the things that we do is we in our community, we buy a lot of facilities from people that we teach about the business. We show them how to underwrite. We send them out there into the marketplace and they begin finding projects and properties using our best business practices for finding these off-market deals where nobody else knows where to look or how to present offers. And then, after that, it's a sequence of events to get you across the finish line, having a good attorney to review all of the documents, having access and a good Rolodex of lenders. And so it's good to identify the banks in that area or that you have a relationship that are interested in self-storage, but they're not going to give you a pre-qualification like they would on a house because the repayment of that loan is based upon the deal. So you may want to, it'd be tempting to talk to your lender and say, hey, I want to get pre-qualified to buy a self-storage facility. I don't know how much I can buy. And they say, well, we can't tell you because the loan's paid by the facility. So once you have a facility that you're looking at, then come back in and we'll talk. But just identifying those lenders, where you're going to find the funds to move forward on these projects. And then after that, it's really just a matter of going out and marketing. So understand the deal, how to underwrite an opportunity to turn it into a self-storage facility, have an idea where you're going to get your funding from, and then ramp up the marketing and have a good attorney at the ready and lenders at the ready so that once you find an opportunity, you can act on it and move on it so it doesn't fall out of contract.
That's great. Thanks for laying that out there so plainly for us as well. But, I know you mentioned looking at, P&L statements that are, currently in place it's a common mistake for new investors and maybe not fully analyze that properly. What are some of the other most common mistakes that you see? Because you coach so many new and put out education for so many new investors in this space. Would love for you to outline some of those pitfalls and things for people to be aware of when they're going through this for the first time.
Yeah, I think all those are covered in the due diligence. And so, the pitfalls are hopefully mitigated during your due diligence. And so for those that aren't familiar with commercial real estate, it's just your inspection period. So once it goes under contract until you close it, you're going to come out of a due diligence phase and then, sign off on those and then march to closing after that. But you have an opportunity to inspect the books and records. You have a time to go out and physically inspect the facility. And I think, Matt, where people make the mistake is sometimes I've seen them and again, don't take this wrong to the brokers in the community, but they just trust the brokers' numbers. And it doesn't mean the brokers don't have good numbers or they're trying to pull the wool over their eyes again, but their numbers are only as good as what they got from the seller. And so going into and finding out, are these the true expenses? Have they included all of the expenses of the facility? And then backing that up by getting the actual bills for the utilities, for property taxes, for insurance, digging through each and every lease in that facility to verify the rent roll, to verify all of the income that's coming in. Do they have their income sources from truck rental or selling locks, boxes, and moving supplies? Well, in some of these secondary and tertiary markets, some of the managers and or owners, they may sell a few locks or a lot of locks or retail supplies and put the money in a pocket instead of in the bank account. And so it doesn't show up. So knowing exactly how much money is coming into and auditing their bank statements, the general ledger for their books and their tax returns to see just exactly historically, what has this facility brought in terms of income in the past and expenses in the past? And if last year's tax return showed a net operating income of $100,000 and they're underwriting and valuing it this year based on $150,000, well, they either need to substantiate it or that purchase price doesn't hold true, and the loan that I would get on that facility would be far too much to be able to cover the debt based upon the income and the expenses that are in place. So the good news is that the bank assists with that a little bit. But at the end of the day, once again, another long-winded answer to your question, man, is that there's many ways that you can trip yourself up if you don't know what you're looking for. And so the old adage, you don't know what you don't know. You might, step in something just out of ignorance because you didn't know what you were looking for or what you should be looking for to begin with.
Yeah, completely fair. And I mean, looking back on your own journey and how you got involved in this niche, are there any things that you would have done differently, or maybe big lessons learned that you had over the years that if you started today, you would do differently, if you're starting from step one?
Yeah, I think there's a few of those that are probably just in practice more than anything. And of course, we've been at this a long time, and obviously we interview people about this as well, and talk to a lot of folks. And the simplest answer is that should have got into it sooner. I should have gotten rid of the tenants and toilets a lot sooner. But that's an easy one. Outside of that, I think some of the other pitfalls that I've made in the past is probably doing more than I should, and the things that I'm not good at and therefore don't like, or even if I don't like it, then I shouldn't be doing it. I need to pass that off to somebody else, hire somebody else, get a virtual assistant to do those things. It's a hard lesson that I think that we all learn as real estate investors. When we have to get the house turned or the apartment turned and ready to rent, or something ready to appraise, we all jump in and we start painting and doing whatever, or finishing some of the carpentry work, or working on the weekends. And the quicker that you can follow Michael Gerber's advice and the E-Myth, and getting out of the business so that you're not working in the business, but you're working on the business, I fell prey to that. So part of that is my controlling nature. Part of it is because I kind of like to do physical work, because I can actually see that I accomplished something. But over the years, I've been far too controlling, and kept my hands into too many things in my business that probably didn't allow us to grow and scale as quickly as we should have. And many of those things would have been done better by somebody who is much better at those tasks and roles than I was. So that's, I'd say that's probably the biggest, is, understanding that I have a value. My sweet spot, my superpower is evaluating deals and raising capital. And if I can spend 80% of my time doing that and 20% doing all the rest, then that's good. But if I'm at a 50-50 ratio and I'm still holding on to those things because I like to do it or control it, or I think I do it better than anybody else, I need to hire somebody to do it, and recognize it's not going to be perfect. It may not be better than me, but I may be pleasantly surprised that they do it better than me. But I can go back to focusing on, my strong suits in the business.
Yeah, I mean, I think that mindset is extremely valuable for any, no matter what profession you're in. So really appreciate that advice, and appreciate you doing this today for us, where you have laid out very actionable steps in a playbook and things to look out for, and potential pitfalls there. So Scott, I really enjoyed the time today. Thanks again.
My
for
pleasure. Me
coming
too.
on here. Yeah. How else can our audience get involved with you and follow up with you and continue the conversation?
Yeah. Well, the conversation can be had anywhere on the socials. So if you just look up Scott Meyers self-storage, you'll find me out there more than basically anybody else. And so we can connect there, but also head on over to selfstorageinvesting.com, selfstorageinvesting.com. My contact information is there as well. Also, a lot of white papers, free videos, lots of resources. We become the place to go for people to at least dip their toe in the water to make sure they don't make mistakes. And so a lot of free resources and materials for those that are looking to get started in the business. And take a peek around at what we've been doing. We are shifting, always have been shifting more towards a mission-based organization. So we take our students and people that work with us onto short-term mission trips where we build houses in Mexico and in the Dominican Republic. And pretty soon that will be the shift in my time, and 80% of my time will be spent on the mission field. Our family will be, and 20% will be in the business itself. And that is our goal. We have a goal to build one more house each and every year than we did the past year. And we're on houses number 15 and 16, and we're building 3 more, depending on when this comes out, in over Thanksgiving of 2021. So we're on a mission to go end generational poverty, one family, one house at a time. So a pretty cool story there if you want to check out that tab as well. And we'd love to have anybody come, if they want to, come along on a short-term mission trip with us. And as a matter of fact, we pay for it. All people need to do is pay for their way to get to San Diego, and we take care of the rest.
I love that. Yeah, I'll make sure we link to all that here, in the description. But Scott, thank you again for the time today. Really enjoyed the conversation.
My pleasure, Matt. Good to see you again.
Yeah, you too. And everyone watching, this is Matt Camp with Deal Machine, and happy deal finding.